We have run a pretty tight trend following algorithm across our different asset classes.
Trend following algorithm.
Yes, yeah,
Okay.
that's some multi-syllabic
Okay.
stuff for you there. But we came back into the markets early in the fourth quarter, and we're there for the rest of the year. I mean, you remember that downturn we had last year? It looked like it was going to turn into something. It didn't, and yeah, thankfully, most people, if they were invested at least, had a great fourth quarter.
Yeah, Phil, I was cracking up reading your notes to us earlier today. You say the key insight for the year is to adopt a George Costanza perspective.
Exactly. So I guess there are probably listeners that don't know who George Costanza is, but on Seinfeld, he made such ubiquitously bad decisions. He decided the best way to lead his life was to do the opposite of what his judgment told him.
Right.
And I think if you look back over the last really 4 years now, you just see that markets were inexplicable. Like in 2020 and 2021, pre-vaccine, right? Markets were soaring after a downturn, of course, in 2020, and really almost no one could have predicted that. Then again in 2022, we thought markets were going to do okay, despite the fact that we thought inflation was going to be transitory, yields wouldn't go higher. Markets got hit very hard. And how many people were predicting a really great market in 2023? Not many. And in fact, if you look at Forbes' collection of Wall Street strategists, that was one of the first times they were ever negative, thinking they would have a 5% loss in 2023. Of course, that obviously didn't happen. So let's just do the opposite of what our best judgment tells us for 2024.
What are your thoughts here as we start the new year?
Okay, so our approach is different than many. In other words, we don't want to be firmly directional for the year. We don't think that's wise for reasons I just talked about. It's almost impossible to predict the markets. So what we embrace is an approach we call a behavioral portfolio. It's an all-seasons approach that does two things. It attempts to allow you to be in core asset classes like stocks and bonds, but do it in a way that addresses contingencies. In my notes that I wrote, I said Gene Fama's a smart guy, but what investors want is not the very best performance. They want to be in the markets but not get blown to pieces. So for equities, take half of your equities, put it into hedged equities so that if markets turn down, you're going to have some potentially bolstering, offsetting appreciation in some things. For fixed income, be adaptive. Like have an unconstrained fund that can be in different parts of the market, T-bills, high yield bonds, investment grade.
When you look at some of the indexes of trend following as a strategy, I look at the CTA ETF as one example, managed futures ETF,
Yes.
The DB cross asset CT index. They had really great 2022s when the stock market was down and the bond market was down. From these indexes, not such a good 2023. When you would think, the equity market seemed to just go in one direction last year. Is there sort of a bias to being short in trend following that you do better when you're on the short side when the market's going down?
Well, so I think you have to be careful what you look at. So if you're looking at CTAs, often they're investing in trend following and futures contracts that are not necessarily the stock market.
Yeah.
Right. And so you want to focus on something that's more of a pure hedged equity play. But right. So often hedged equity strategies will trail during a rise market, and I think that's why this combined approach of being hedged equities for half of your equities, just conventional stuff for the other half of your equities. On average, if you would have done that, you still would have probably been up, nicely double digits, maybe a little over 20%, not all the way with the market, but you would have been there for the markets.
So how much cash do you have now, or are you essentially fully invested?
Zero cash. So
Zero
when
cash.
when we went long,
Okay.
Now I say that with one caveat. In some of our unconstrained bond strategies, we do have some T-bill exposure presently, but across all of our equity strategies and everything else, we're fully allocated.
So in fixed income, fixed income actually had positive returns in 2023 after a disastrous 2022.
Right.
What do you think here? Am I in fixed income? Do I go take credit risk? How do you guys look at that?
Yeah, so I think the mistake that many people are still making is they're looking at how great T-bills were in 2022 and the first part of 2023 and saying that's our bet. Or we're going to go to CDs or fixed annuities or something like that that'll earn a 5% rate. That's the wrong trade. And the reason it's the wrong trade is if you look at the history of investment grade bonds and high yield bonds during a time when the Fed is easing, there have been historically great returns, ranging up as high as 50% sometimes. So this idea that 5% is the best thing anymore has to vanish. So we look at a couple of scenarios. Look at soft landing, hard landing, no landing, as long as inflation is not resurgent, right? As long as that key measure stays low, I think bonds do pretty decently. And then that one contingency, which I do think you have to address, the possibility that inflation comes higher, that could put bonds underwater again. So you need to be, that's why I say agile and unconstrained with your bond approach.
So when you go heavy into cash, it's more a reflection of what you expect the stock or bond markets to do. It's not that yield you're getting on cash in a money market fund or wherever, or T-bills, that is influencing the decision.
Exactly. We're just going defensive. We're not making a prediction. We're just reacting to what's happened to the markets, but we're just going defensive.
So when I looked at the fixed income returns for 2023, I was really surprised to see that the real money was made in high yield,
Right.
kind of a 13, 14% total return. And that's in the midst of everybody every day talking about a recession where I would think you wouldn't want to take credit risk. Why did high yield do so well last year?
Well, I think it's just a function of a couple of things. One of the main things is that, earlier in 2023, high yield bonds were yielding close to 9%. Right, so if that's your starting place before you have any appreciation, that potentially looks very good. And then the fact that we had this strong fourth quarter, and high yield bonds rallied a lot in the fourth quarter. So what you were talking about earlier is a big part of what happened.
And Phil, in true Costanza fashion, it looks like you've invented your own holiday here, the National Investment Risk Day. What's that all about?
Yeah, so someone on my staff created this on my birthday, January the 19th, and it's actually registered with the National Archives. It is a holiday. You can find it.
It's the Festivus for investors?
And we used to have a no acronym policy, but now we've called it Nerd Day, NIRD. But here's the thing, is like we continually watch these investments that are super horrible ideas become very popular and then maybe have trillions of dollars of net worth. And what's so fascinating is that often the biggest financial institutions in the world get on board. And so what we're trying to do each year is look at things that are like that, things that are absolutely crazy. What are the most insane ideas that happened in 2023? We have an esteemed staff like the behavioral economist Dan Crosby, Brian Portnoy, and I think even a Bloomberg columnist is coming on to oversee the webinar. So we're looking forward to that on the 19th of Jan.
In 2024, what are you going to stay? What are you staying away from here? Is there something here? I don't know if it's geopolitical risk that's causing you to shy away from something. What do you stand away from, do you think, at this early stage?
Well, at the moment, it's cash.
Okay.
At the moment, you just stay away from T-bills because I think that's the losing trade. Now, I say that understanding that things can adapt very quickly. I mean, we're seeing clearly we have really strong sentiment, and sentiment indicators kind of off the charts coming into the end of the year. So just that alone would say that we could have a downturn here. I don't know how big it could be, but I just think, if you already missed 2023, if you were in cash and you didn't experience what we had in the fourth quarter, but also the rest of the year, that doesn't bode well for what may happen in 2024 if you stay in cash right now.
Yeah.